Welcome everyone to this webinar, Investing in the Post-COVID World. My name is Sam Wylie. I'm a Principal Fellow of the Melbourne Business School, which is the graduate business school of the University of Melbourne. And I'm also the founder of Windlestone Education. So we're going to start the webinar by looking at the major changes to the global economy over the last 4 years since the beginning of the COVID crisis from the perspective of investors. Then we're going to take those major changes and look at what that means for your portfolio, focusing on two things in particular. Firstly, your allocation to US shares, what proportion of your overall portfolio is invested in US shares, and why you might want to think about increasing that on the basis of the events of the last 4 years. And then secondly, how much you are borrowing to invest, typically in real estate, and the importance of the uncertainty over what's going to happen to real interest rates for how much you borrow to invest. So we're going to start off with the big changes, then we're going to look at investing in US shares and allocation of that, and then we're going to look at what uncertainty about real interest rates means for borrowing to invest. Here we are, investing in the post-COVID world. This is actually the 8th webinar in a series of webinars on macroeconomics, which I started during the COVID crisis. And we'll have another 3 webinars this year, some of which will deal with issues and topics that we will delve into today, go deeper on those topics and expand them. Now, if you don't have a copy of the slides, then you can email me and we'll send you a copy. So as I said, we're going to first of all look at these major changes to the global economy that occurred during the COVID crisis. And much of this is really acceleration of trends that existed before the COVID crisis. Then we'll look at the asset markets, the stock market and the bond market. And then we're going to look at what these changes mean for your choices. First of all, to do with asset allocation, which of course means how much of your portfolio is allocated to US shares, global shares, Aussie shares, to real estate, residential real estate or commercial real estate, to private assets, by which I mean infrastructure, private equity, venture capital, etc. If you don't know what those things are, then you should think about taking my investments course, which I'll talk about a bit more later on. But in any case, we're going to look at what these changes mean for your allocation to US shares and why you should think about increasing that allocation. Then we're going to look at leverage, how much you borrow to invest, which is almost certainly for property. And we're going to look at the effect of uncertainty about real interest rates on how much people should borrow to invest. And we'll see why that uncertainty means that until that uncertainty is resolved, lower levels of leverage are going to make sense. Okay, so let's get into the first part, into the differences. What's changed? Well, of course, there was transformational technology that emerged during the COVID crisis. And some of these were just towards the end of the COVID crisis, of course, or even into 2023. That's when ChatGPT-4 emerged and all of AI moved more into people's focus. Then we also had recently the anti-obesity drugs, Ozempic and the like, which are going to be so transformative. Gene therapy, for the first time, was used to cure someone of sickle cell anemia, to cure someone of a congenital condition for the first time ever. I mean, these are really incredible changes and a really incredible acceleration of the rate of innovation. That's one thing. Another thing is that over the last 4 years, global warming has accelerated, and especially in 2023. This is the hottest year ever until 2023, which was 0.16 degrees hotter than any other year previously recorded. So that's a major acceleration, and we'll see what that means for investors. It's really going to come down to the $100 trillion that's going to need to be invested in the global economy to bring about decarbonization of the global economy and the effects that that's going to have. And then, of course, there was an incredible change in demographics. This is a trend that's been going on for a long time. And here I'm showing in a graph China's birth and death rates. But this is very dramatic. I mean, look at this. This is a halving of the birth rate in China. 19 million babies were born in China in 2016. And about 8 million were born in 2023. I mean, it's a demographic collapse. Now, I bring this out because it's so significant for China, but this is something that's happening around the world. And it was accelerated in COVID-19. So a really critical trend for investors, a really major investment mega trend was significantly accelerated in COVID-19 around the world. Now, it's also true that global trade slowed a lot over COVID-19. So there's been an amount of slowing of global trade, but that really accelerated in COVID-19. And global trade has been such a driver of investment returns, and especially a driver of disinflation, of powerful deflationary forces in the world, which we're going to talk about so much more when we come to talking about real interest. That accelerated in COVID-19. And just here, while we're on the matter of trade between China and the developed world, and especially with the United States, let me just point something out here that over the last 4 years, investors lost confidence in China's growth story. And I'll show you what I mean by that. So what you can see in the color coding here is the GDP, the nominal GDP. I don't mean the parity pricing GDP, but the nominal, the US dollar GDP per person in 2023 across countries. And China is in this range here. This is actually $13,000 in China. I'll show you that in just a moment. But China's in this range here, which is often referred to as the middle income trap. And what's meant by that is that so many countries have begun their development journey and got stuck in here. If you think about Chile or Argentina or Brazil or Mexico, or come over here to Turkey, to Hungary, to come down here to Malaysia, etc. It's the most common thing in the world for developing countries, and these other countries are down here. They're still on their journey. They're below the middle income trap. But the number of countries that have developed through this range and emerged onto the other side, you're really looking at what was already the developed world, of course, and then oil-rich countries, and then some countries, Japan, Korea, Hong Kong, Taiwan, of course, both of them are part of China, but those countries have made their way through the middle income trap to fuller levels of development, but that's very rare. And people have had it in their mind that China would do that, would accelerate through the middle income trap, but now a lot of investors don't believe that they will do that. That China's economic problems, which we'll talk about in another webinar, that'll be one of the 3 webinars that we have this year. China's economic problems are very significant structural and permanent problems that will leave them here or slightly above the middle income trap. And that's the point of view that changed over the last 4 years. Now, something else, I should say, just before I go on to government debt, I should say that both President Biden and former President Trump, neither of them are really free trade people. Both of them have protectionist policies. So this reduction in global trade growth and the tensions with China, we shouldn't expect that to change after the presidential election, regardless of who wins. And another thing that we shouldn't expect to change is that either of the current president or the former president will take the slow motion train wreck that is US government debt, will take that seriously. Neither of them ever talk about it. Neither of them show the least bit of concern. For both of them, it's spend, spend, spend. Now, this really is a slow motion train wreck. Government spending has been accelerating, or I should say the level of government debt in around the world as a fraction of GDP has been growing for a long time, as we've spoken about in previous webinars. And that is a slow motion train wreck. It's additional debt to make up for the fact that supply is growing faster than demand. When the growth rate of supply of goods and services is greater than the growth rate of demand, there's this gap that has to be closed by extra debt if you're going to fight deflation. Otherwise, if supply grows faster than demand over long periods of time, then you have falling deflation, which will eventually fall into outright deflation. You have falling inflation, which will ultimately become outright deflation. And the accumulation of debt to close that, to create extra demand, to close that gap, to fight deflation is something that we talked about in previous webinars. Well, that was really accelerated in COVID-19. The slow motion train wreck, that is the accumulation of government debt, has been sped up. And now what you have in the United States now is that there's really no appetite to fight that. So there was a group, the Tea Party group in the Congress, a part of the Republican Party, who were utterly opposed to the growing US debt. But even they, in 2023, essentially rolled over on it. So now there is no real resistance to the accumulation of additional debt. And that's a slow motion train wreck that will eventually become a fast motion train wreck. And we'll talk about that more in another webinar. Now let's have a look at the markets. The S&P 500 from the beginning of COVID to the present, to here at the beginning of April in 2024, up 58%. And we can see that some of that, this part here, from the depths of COVID through to the end of 2021, December 2021, early January 2022, this was really driven by rapidly rising profits. Now, what's being shown here is actually cash coming out of the 500 companies in the S&P 500. So cash in the form of the payment of dividends or the buying back of shares. You know, in the US, more cash comes out of companies in the S&P 500 by buying back of shares. When companies buy back their shares, that's cash out of the company. When companies pay dividends, that's cash out of the company. Cash in both cases being returned to shareholders, return of capital to shareholders. But you know, as in many countries, many shareholders like to receive cash in the form of the selling of their shares back to the company so that they pay capital gains tax, rather than paying income tax, which is what will happen if they receive dividends. So typically buybacks are larger in volume of cash than dividends in the United States, and that's true in some other countries as well. But here we can see the volume of cash coming out of the 500 companies in the S&P 500. Look, it surged through COVID here, but then it fell off and actually isn't very much higher than it was pre-COVID. You know, it was about 1.2 trillion. And here it's about 1.4 trillion. Now, I mean, I know that's 15 or 16% higher, but that doesn't account for the 60% higher S&P 500, the 58% higher S&P 500. So, you know, what has driven shares to such a high level is the belief that earnings and ultimately the cash flows coming out of companies will go way up. There's an expectation of a growth in earnings and ultimately cash flows, because in the end, it's really cash coming out of shares that matters, that'll go up. And also the belief that interest rates will go down. So you can see here, this was driving the market up until the beginning of 2022. And now we've had a surge in stock prices since October 2023, where the market is way up, even though there hasn't been a surge in cash coming out of these companies. So there's an expectation of growth in the future. Now, when we look at this measure of the valuation of US shares, of the S&P 500, the Shiller cyclically adjusted price to earnings ratio, the CAPE ratio, the cyclically adjusted price to earnings ratio, which is generally accepted as the best measure of whether the market is over or undervalued, then what we see, and let me just say that the CAPE ratio is the average of the 10-year price to earnings ratio, the price divided by 10-year average of real inflation-adjusted earnings per share. So for a company like Citigroup, for instance, you take the price of the share today, you divide it by the 10-year average of earnings per share with the earnings per share adjusted for inflation, and then you have the CAPE ratio, the cyclically adjusted, beyond cycles, price to earnings ratio. Now you can see that at the moment is the third highest it's ever been. So you would think that the market is, I mean, on this basis, you would say that the market is at very high levels of valuation. And what underpins those very high levels of valuation, the beliefs that underpin that are that earnings growth will accelerate, and a lot of that is driven by the expectations of artificial intelligence, but also that interest rates will come down, and especially that real interest rates will come down. So these very high valuations are driven by two things. The expectation that earnings, this is showing cash rather than earnings, but that earnings and ultimately cash will accelerate substantially, and that real interest rates, that interest rates, these are long-term interest rates, these are 30-year Treasury bond yields in the United States, that these interest rates will come down. Now notice that this is something that changed this was a very material change in COVID-19. That this long-term, by long-term we mean from the late 1980s all the way through to 2020. So here we're talking about 32, 33-year trend, downward trend in the yields on 30-year Treasury bonds. And two things were driving this. These are the yields, down, down, down. This is a secular downward trend. Secular here doesn't mean the absence of religion. It means something beyond cycles. Sure, there's cycles here, but there's something going on beyond cycles. Secular decline. And two things are driving that what investors need in terms of the yield they get for lending money to the US government for 30 years, that's what these Treasury bond yields are, is they need compensation for inflation or the expected inflation so that their wealth is not eaten away by inflation. And then they need the time value of money, something beyond that. The yield with inflation taken out, the real yield, not the nominal. And the reason that Treasury bond yields were down, down, down over these 33 years is because both inflation expectations and real interest rates declined. Now, there was a breakout at the beginning of COVID from this 33-year cycle. And we can see that this breakout is really to do with this, with real interest rates. This increase in 30-year Treasury bond yields is not a de-anchoring of expected inflation, not increase in inflation expectations. It's an increase in the real interest rate. Look, we can add the real interest rate to this graph. See, this is the same graph, but here we have the real interest rate component. And you can see that was down close to 50 basis points, 0.5% to 1% in the pre-COVID years, post-GFC, pre-COVID, and then for a period negative, and then it's the increase, it's this 3% increase in real long-term interest rates that have driven long-term interest rates up, the required return on long-term investments. You know, on every type of long-term investment, investors need a return that has three components. They need what they can get on long-term government bonds, which is what we were just looking at. They need a compensation for the risk that they're taking, and they need something for how hard it is to buy or sell the asset, a liquidity premium. Now, on shares, the liquidity premium is very low, close to zero, because it's very easy to get into and out of the S&P 500. So the required return of investors is the yield on long-term government bonds plus a spread called the market risk premium above the yield on government bonds. Now, we're not thinking about the market risk premium here. We're thinking about the yield on government bonds. When the yield on government bonds goes up and down, the required return of investors in the share market goes up and down. Now, when their required return goes up, then the price of shares goes down. I mean, the way you can get a higher required return is if you pay a lower price. That's true of any kind of investment. So when long-term government bond yields go up, share prices go down. Investors have a higher required return and share prices go down, unless they expect that to be reversed. And that's what's going on at the moment. It's clear that what's implicit in the record high levels of the stock market at the moment, as we could see from the CAPE ratio, is that investors are expecting that increase in the 30-year government bond yield to be reversed. And of course, that increase is real interest rates, long-term real interest rates, not inflationary expectations. They're expecting those real interest rates to go down. That's why the market is so high. If they thought that that's permanent, that increase in real interest rates, then the market would be much lower. So what's embedded into these very high levels of the S&P 500 at the moment is earnings growth, and some of that is to do with AI, quite a lot of that is to do with AI, and then a decrease in long-term real interest rates, which is really a statement that the market's expecting deflationary forces to come back. But we'll talk about that some more in just a moment. So just to recap that, This very high level of the market in valuation terms, high earnings growth expectation, low real interest rates, an expectation that this will turn around and go back here to 50 to 100 basis points, 0.5 to 1% long-term real interest rates. So just to sum this up, we've had these very large changes in the global economy, and we're going to see that revolutionary tech is having a big effect on US equities, and I'm going to talk about that in the next section here. But these parts are all driving real interest rates. And these are all trends that existed before COVID-19 came along, but were accelerated in COVID-19. And in the last part of the previous section, we were talking about the US stock market and these long-term bond yields. So there's been large and enduring changes to economic conditions since the beginning of the COVID crisis. Now, when that happens, investors need to change their portfolio. If investors don't change their portfolio after large changes to economic conditions, then they don't have a proper investment process. What does it mean to have a proper investment process? Well, let's just remind ourselves. It starts with the setting of life goals, and from that, financial goals. Money is our servant and not our master, but we need to reach our financial goals to live the life that we want to live. Now, to reach our financial goals, we need to make choices. And those choices are of several types, but the most important part is the choices about investment strategy. So these four parts, the what of investment strategy, what are we going to invest in? Aussie shares, global shares, especially US shares, fixed income, meaning bonds, real estate, residential real estate, apartments and houses, commercial real estate, shopping centers, office blocks, industrial parks, etc., private assets, again, infrastructure, private equity, venture capital, etc. So what are we going to invest in? And then where are we going to hold those assets? In what structures? Are we going to hold the assets directly, such as we would if we had a negatively geared property? Are we going to just hold direct title, or are we going to hold the assets in our superannuation fund? Are we going to hold them in a family trust or an investment corporation? So where to hold the assets, what to hold, where to hold them, and then how to manage risk. Risk in by borrowing to invest, that's almost always for property, and risk out through insurance. And then there's the implementation of strategy. So if you decide to make an allocation of X% of your investments to US shares, then what do you do next? Are you going to implement that by investing through your super fund, getting a super fund to do it for you? Are you going to invest in exchange traded funds? Are you going to invest directly in shares using a discount brokerage firm or a full service brokerage firms? There's lots of different possibilities for implementation, and you need to make a choice about that. So these four parts, these four types of choices make up investment strategy. What to invest in, where to hold those assets and your tax strategy, the how of managing risk in and risk out, and then implementation. Now, there's other important decisions, how much to save, financial advice, etc. But strategy is especially crucial. Now, we're leaving out here the risk spectrum, and let me just talk about that for a moment before we go back to focusing on strategy. And your position on the risk spectrum means on the basis of your individual characteristics, how stable is your income? Are you a teacher in a public school, so you'd have super stable income, or do you own a risky small business? So if you were a teacher in a public school, then you'd be over here, further to the right, able to make more risky choices. If you were the owner of a small business, a risky small business, then that would mitigate to you taking less risk, being more conservative. And then your age comes into it, older, younger, in terms of less risk, more risk, any special obligations you have in life, your personality, how much risk can you absorb and still sleep easily at night, etc. So your personal characteristics position you on the risk spectrum, and that determines some of these choices. So if you are someone who should be taking a lot of risk based on your personal characteristics, then you're going to invest more in the risky asset classes of shares and property. And if you're someone who should be taking less risk, then you're going to invest more in cash and bonds, low risk asset classes. So this is very important. Now we're really going to focus in our following discussion on these two things. The part of asset allocation that is how much to invest in US shares, that's going to be the next part. And then how real interest rates, how uncertainty about real interest rates affects the amount of borrowing that you do, almost always with property, affects the amount of borrowing that you do, and how you should think about that. That's what we're going to come to. This first, and then that. Okay, so let's get into it. A higher allocation to US shares, driven by US tech dominance. What was the biggest mistake that investors made in the 20th century? Well, across all investors and across all the decades of the 20th century, the biggest mistake was not to be invested enough in US shares. US shares absolutely saw it. They delivered inflation plus over 7% throughout the whole of the 20th century. And if you were a non-US dollar investor, then US shares were especially good for you. So for instance, if you were a UK investor, in 1930, a UK pound was worth $5 US. Now it's worth about $1.15, between $1.15 and $1.20. So if you were a UK investor into the US markets, you got a 4 times uplift in the value of your investment. And even if you're a US investor, your investments went up hugely during the 20th century. Let's have a look at that. The biggest mistake in the 20th century, to be underweight US shares. $1,000 invested in US shares in 1900 grew to $135 million in 2024. And in real terms, with inflation take out, $1,000 grew to $4 million over that period of time. Here I mean $1,000 invested in a diversified portfolio of all the listed shares on US stock markets. And we're not including tax in this, and we're assuming that investors are reinvesting their dividends. But $1,000 to $135 million. As I was saying just a moment ago, if you were a UK investor investing £1,000, then it wouldn't have grown to 135 million pounds. It would have grown to 520 million pounds, twice as much because of the uplift in currency. Now, I think that there's good reason to believe that this is the same mistake. This will be the same mistake in the 21st century. The biggest mistake people will make is to be underweight US shares in the 21st century, because it's going to be all about tech. To not have a very large allocation to US shares, you have to believe that the dominant force in the 21st century isn't going to be tech. Now, look, it's possible that it'll be geopolitics, for instance. That also would lead you to want to invest more in US shares, by the way. But look, it's possible that it's not going to be all about tech, but I wouldn't bet on that. Tech's been just the most incredible driving force throughout all of human history. And US dominance in tech is nearly complete. Now, we can certainly think of some tech firms outside of the US. So we would think, just in the space of AI, we would think of TSMC, the Taiwanese chip manufacturer that has such a dominant position in the fabrication of chips. We would think of ASML, somebody mentioned that earlier, in terms of creating the masks and the optics that are used to etch chips. So that's a Dutch firm, I think. And some others, very high-tech firms outside of the US. But honestly, for every high-tech firm outside of the US, I could name 3 high-tech firms inside the US. There's such a dominant position in tech, and it comes out of these things. It comes out of the level of investment in tech and R&D, which is not only is the US the largest economy in the world, but it just has the largest proportion of investment in R&D of all the large economies. The fabulous universities that the US has, and there's been this virtuous cycle between the universities and venture capital ecosystems, where the venture capital firms set up around US universities, whether that's in Silicon Valley or in Texas around Austin, or in North Carolina with a big biotech conglomeration, or around the universities in Boston. So these big universities and research centers, venture capital setting up around that, and then the endowments of universities being the beneficiaries of the increase in value in venture capital, and also very large gifts from their alumni. Then you've got the large US military and the amount of tech research and spending that goes on here, and the training of people in high tech, because the US military proudly says that we are an education institution. Everyone who comes into the military leaves with a lot more skills than with what they joined. And then you just have this incredible entrepreneurial culture in the United States. Tracy and I lived in the States for 7 years, and we were always amazed by just how far tech, the love of tech reaches in the US. It reaches into every crevice of US culture, whether it's sport or art or music or, of course, commerce, everything. There's just this love of tech and embracing of tech. So in any case, US tech dominance in the 21st century. What does that mean in practical terms? Well, look, this is education and not financial advice that we're doing here. So I'm not telling you what to do, but I can tell you, for me, I'm going to increase Tracy and I are going to increase our allocation to US shares from 30% of our portfolio to 35% of our portfolio. It was already very high because of our concern of making this mistake, and we are long-term investors, but we're going to increase it on the basis of the acceleration of the dominance of US tech, how much the 21st century is about tech. Now, here's some sort of purely practical questions. How quickly should I increase my allocation to US shares? And look, that just depends on how much you have to increase, and of course, how easily you can sell down the assets that you're going to liquidate to get into US shares. So you don't want to bring about a lot of capital gains or a lot of other transaction costs in order to move quickly into US shares. But it also depends upon the things that we were talking about earlier in the webinar. So what's built into the very high valuations of US shares at the moment is the belief that earnings are going to grow a lot and that interest rates, especially real interest rates, are going to come down. Now, I think that that's definitely going to happen in the long run. Is it going to happen in the short run? Are we going to see a surge in earnings in the short to medium term and a decrease in interest rates in the short to medium term? Now, look, that is a genuine concern. And what it means is that you will want to spread out, investors will want to spread out their investment into US shares. If you jump into a big allocation to US shares, especially if you reduce your allocation early in the COVID crisis to US shares, jump back in at the moment with the CAPE ratio at such a high level, obviously there's a timing risk there. You could be jumping in just before the market heads way down. Timing risk is always the long-term risk in investing in shares. We know that the share market will go up, especially US and Australian share markets will deliver high returns in the long run. But the risk is a timing risk, that you jump in just before the market goes down a lot, or that you exit just before the market goes up a lot. And the way to mitigate that timing risk, to reduce that timing risk, is to get in slowly and get out slowly. So the higher your transaction costs of getting out of whatever it is that you're going to sell to go more into US shares, and the higher your concern that the market is overvalued because the US stock market is not going to soon deliver big increases in earnings and cash flows coming out of those shares, and or a decrease in interest rates. If you're concerned about that, then you'll want to slow down your entry into the US market. But you've got to get to a full allocation. You know, there's always a reason not to act. And so the main thing is to have a plan and stick to it, to get fully invested, even if it's over quite a number of months and quarters or even years. You've got to have a plan to get fully invested. Because if you stay out of the market, you're going to end up making the mistake that we've been talking about, being underweight US shares in the century where US tech dominance is going to be absolutely crucial. And then what about avoiding the largest US shares? The big eight, Microsoft and Apple and Nvidia and Tesla and Amazon, Google, etc. So these shares that have surged so much because of the belief that they will be the beneficiaries of the surge in artificial intelligence. Well, look, I am concerned about that. I'm concerned that what will happen is that these firms will turn out to be the Ciscos of 2024. Now, what I mean by that is in 1998 seems like yesterday to me. I'm an old guy, so but probably not to you. But in 1998, as I said, I remember that like yesterday. In 1998, people believed, this is in Web 1.0, when the first wave in the dot-com bubble, in the first wave of excitement about the internet, people believed that the firms that made the plumbing of the internet, that was Cisco, Alcatel, Nortel, Intel, those companies that made the routers and made the chips of the internet, that they would be the beneficiaries of all the value created in the internet. Now that turned out to be false. It turned out that those companies were more like the manufacturers of utilities, and that people are sort of utility services and products, and that it wasn't the plumbing of the internet, it was people who built platforms on top of that infrastructure of the internet who created an immense amount of value. The Facebooks and Amazons and Googles of the world. Now, I think there's a real likelihood that that happens again in the AI revolution, that the people who create the large language models are actually just going to be creating something that will become somewhat utility-like, and that the real value creation will be, in just ordinary companies becoming more efficient, but also in companies who build the products that sit on top of those large language models. And what are the names of those companies? Well, we don't know. They're being dreamed up in dorm rooms at the moment. And we'll find out. But if you invest in the whole of the market, you'll be the beneficiary of that. If you overweight to the companies who are the current beneficiaries of AI, the Nvidias and the Googles and the Amazons and the like, then there's a real danger that you're making the Cisco mistake. So I don't like being overweight these big companies. And so what should you do? Well, one thing you can do is to either go to one of the indexes that is weighted much more to small shares, like the Russell 2000, or to invest in an equally weighted portfolio. So Microsoft's about 6% of the US market, about 6.5% of the US market in a value weighted S&P 500, but in an equally weighted, it's just one part in 500. So it's 0.2%. So for me, I like equally weighted at the moment. Should I invest only in tech shares? Certainly not. You don't know which tech shares it's going to be, but also a lot of the value will be created in ordinary industrial shares. What's the best way to invest? Through ETFs, direct ownership of shares, etc. Look, I really like ETFs, but in many ways, this is a question for my investments course. How to implement. This is the question of how to implement your strategy. We're on to the what of investment strategy here. What are you going to invest in? How much into US shares? And we were talking earlier about the importance of the where are you going to hold it in your family trust, in super, directly, etc. And the how are you going to manage risk, how much to borrow to invest. I'm coming to borrowing to invest in just a moment. But this is the implementation part. And I'll talk about my course in just a moment. Now, you know, the just investing in all of global shares is you have a very large weight into US shares. I borrowed this slide from Dimson, Marsh and Staunton. And you can see that from 1899 across this is really an expression of just how successful investment in US shares was across the 20th century. But the US is already 60% of the global share market. I'm inclined to increase my weight of investment in global shares to beyond that 60%. Okay, now just something on my Finance Education for Investors course. So the course is coming up on the 2nd of May in a few weeks' time. It runs for 10 weeks. It's live from 7 till 9 p.m. on Thursday nights, 10 Thursday nights, starting on the 2nd of May. But you don't have to attend the live courses to take the whole of the course. You can watch the course on demand. So after the live course each week, the videos come out of the class. They are pre-recorded. And so you can't miss a class because you can watch the class at any time. Most people like to attend the live classes and to get in the rhythm of doing that, but many people take the course without ever attending live classes. You have that flexibility. It's all about empowerment and getting to better outcomes. And empowerment here means the getting rid of the feeling, making the go away, the feeling that there's big parts of finance that you don't understand. There's things that other people understand about investing that you don't understand. And also the feeling that you don't know how to start, that you can't get traction, and you don't know who to trust in the environment ecosystem in terms of financial advisors and mortgage brokers and accountants, etc. So empowerment in your investing and getting to better outcomes, of course, means reaching your financial goals more quickly. You know, we concentrate a lot on setting financial goals and then making the choices, developing the investment process to get to your goals more quickly. So it's all about investment process, a lot of knowledge, and a self-guided examination, week by week, examination of your investments and what to do to improve your financial situation. So it's $1,200 per household. Everyone in the household can take it together for $1,200 plus GST. And it's everything you need. It's the live classes, the videos on demand. It's a lot of resources. There's a limited number of participants, and about half the class will eventually will choose to have a one-on-one discussion with me. So about 2,000 people have taken the course, a little more than that. They've had a brilliant experience, I can say without a hint of modesty. If you want more information, go to windlestone.com.au to enroll or to get more information, as I said. But it's coming up soon on the 2nd of May. All right, next part, real interest rates. So let's just dive into this straight away by looking at Australian inflation. So these are the most recent Australian inflation figures, and we're going to concentrate here on what the Reserve Bank of Australia concentrates on, which is the trimmed mean of inflation, where they trim off outliers on either end of the inflation data. And so trim mean at the moment, 3.9%. Now it's real interest rates that we're interested in. And so let's just explain what we mean by that. So at the moment, the cash rate, the overnight interest rate that is set by the Reserve Bank of Australia, that is 4.35%. That's the red line here, the cash rate through time, from the early 90s through to the present. And you can see also another line here, which is the 90-day bank bill swap rate. That's the rate, interest rate you face if you're borrowing to invest in property, in commercial property. And we're going to use that in just a moment, but we don't need it at the moment. What we need is the RBA cash rate, and those two things track each other pretty closely anyway. Here we've got the RBA cash rate, 4.35%, and we can break that down into inflation, which we just saw a moment ago is 3.9%, and the real interest rate. Now, when we previously looked at real interest rates, I had real interest rate on top and inflation below, but it's going to work better here like this. So we're decomposing the short-term interest rate set by the RBA into inflation, not expected inflation, but actual realized inflation for these short-term interest rates, and the real interest rate. So you can see here, real interest rate, 0.45%. The real interest rate, 0.45%, plus inflation of 3.95% gets us to the cash rate. Now that's true through time. So we used to have, before the GFC in Australia, real interest rates of around 2 to 2.5% here. So to get to the cash rate, you would take the real interest rate, 2 to 2.5%, add inflation, and that'd give you the cash rate. And then to get to mortgage rates, you'd add the bank spreads on top of that, which are usually about 1.8% to 2%, 180 basis points, 200 basis points on here. But before the GFC, about 2.5%. Now, after the GFC, and especially after the sovereign debt crisis, where Greece nearly went out of the European Union, out of the Eurozone, I should say, the real interest rate fell to, and this was caused by the RBA fighting deflationary forces. The RBA cut interest rates, cut, and that caused the real interest rate to go down to zero, fighting deflationary forces here. And to stop inflation going too low, they cut interest rates. And real interest rates after the GFC down to zero, going into COVID at zero. Now, of course, we had the very unusual circumstances of COVID where interest rates get cut to zero. And then later we have inflation, but interest rates are still zero. So the real interest rate went very negative, but now we're getting back to normal. But what normal are we getting back to? This is the key question. So are we getting back to this normal, the pre-GFC normal, or are we getting back to the pre-COVID normal? Now, this is such a crucial question because you think about what's going to happen to mortgage rates here. Mortgage rates, if we go back to zero real interest rates, mortgage rates will be that zero real interest rates plus inflation, which will be about 2.5%, plus bank spreads, which will be about 2%. So mortgage rates will go back to about 4.3 to 4.5% if we get down to here. And the cash rate will be something like 2.5%, go down to here, if this is what happens again. But if we go back to this world, and a lot of economists think we do go back to this world. So Charles Goodhart, the famous British economist, and famous American economist Larry Summers, that for different reasons believe we go back to this world. And I'll talk about what these reasons are in just a moment. But they believe we go back to this world. Now that's a world where you start with 2.5%, you add 2.5% for inflation, and that would mean that this has to go up. That's a world of not higher for longer. That's a world of higher forever. That the equilibrium level of the cash rate would be up here. 2.5% for real interest rates, 2.5% for realized inflation up here. And then you add nearly 2% on top of that for bank spreads, and you get mortgages up here. Now, it's obvious what that would mean for the real estate market. That would be very bad for property prices if we head back into a world where mortgages are typically 7%. Now, that's this world. This world, mortgages are 4.5%. And that's a world in which property prices could go up, not necessarily hugely. And we'll talk about property prices more in another webinar, just as we have in previous webinars. But this is huge. This is what I mean by uncertainty about real interest rates and the consequences of this, especially for property prices, but for the cost of borrowing, anything that really depends upon the cost of borrowing. Residential property prices, apartments and houses, commercial property prices, offices and industrial property and the like, warehouses and the like. Anything that depends upon the cost of borrowing, this decision is immense. Now let's look at the US data. So same thing in the US, and here we are taking out inflation, and the inflation that we're taking out is the core PCE, the core personal consumption expenditures, the growth in that, and that's what the Fed looks at. Just as the RBA looks at the trim mean inflation, the Fed looks at core personal consumption expenditures, and you can see that in the same period where real interest rates went to zero, short-term real interest rates went to zero in Australia, in the US they went negative. I mean, the fight against deflation was much more difficult in the US post-GFC. Again, pre-GFC, we did have this period. The dot-com bubble was a much bigger deal in the US than in Australia because of US tech dominance. And Australia didn't really have a bursting of the dot-com bubble. We don't see something big happening at 2000 in Australia. In fact, we had a mining boom in Australia, mining boom 1.0 here, and interest rates going up. The US at the same time had the bursting of the dot-com bubble and interest rates going down. And these very low real interest rates fueled a surge in property prices, which in the end caused the GFC. But in any case, let's think of going back to this world of 2.5% real interest rates, 2 to 2.5% real interest rates, versus going back to a world of 0% real interest rates. Are we going back to this, or are we going back to something more like this? There's a 3% difference here. And for investments where the cost of borrowing to invest is dominant, this is a very dominant question. Now, if we look at longer term interest rates, in breaking down longer term interest rates, we're not breaking it down. Just excuse me for going back here. Here we're talking about short term interest rates set by the central banks, by the Reserve Bank of Australia or by the Fed, and breaking it down into realized inflation and real interest rates. And when we're talking about long term interest rates, the yields on long term government bonds, and these are US Treasury bond data that we're looking at here. Then we're breaking it down into expected inflation, what investors expect to happen over the next 10 years, and then into real rates. And we saw this graph earlier. So we take the yields on 10-year government bonds, we take out expected inflation, and we have the yield, the real interest rates, the real yield on 10-year government bonds. And we looked earlier at how the surge in long-term government bond yields, we were looking at 30-year government bond yields in the earlier slide. But with the 10-year government bond yields, it's the same story, that this surge in government bond yields since the beginning of COVID is because of ending a long-term downward trend, is because of a surge in real bond yields, real interest rates. Now, one distinction that we should make between short-term interest rates really driving the cost of borrowing and long-term interest rates driving valuation. So when people are valuing long-term assets like shares, long-term bonds, real estate, infrastructure, etc., then they're using long-term interest rates. Once you fix the cash flows on any asset, whether it is fixing in your mind what the dividends are going to be on a share, or and plus the buybacks, of course, but what the cash coming out of a share is going to be, once you fix that in your mind, or you fix in your mind the rents of a property or the coupons, the interest payments on a bond, once you fix the cash flows of an asset in your mind, then to get a higher return, you have to pay a lower price. So there's this direct inverse relationship between the price and your required return. If the cash flows are fixed, then the only way you can get a higher return is if the price is lower. So your required return is made up of your required return on the long-term government bond yields. That's what you can get without taking any risk, plus a market risk premium, plus something for liquidity, but that's not a big deal in shares. So you need the yield on government bonds because you can just put your money in government bonds for a long period of time and not take any credit risk. There's obviously interest rate risk, but not credit risk. Plus, you need market risk premium for the riskiness of investing in shares. And that market risk premium is typically 5 to 5.5% over time. But as the required return goes up and down, as the yield on government bonds goes up and down. And that drives the price up and down. And so that's why I'm emphasizing the yield on government bonds, long-term government bonds, as driving valuation. As this yield goes up, the amount that people are prepared to pay for long-term assets goes down. Down here, it's more about driving the cost of borrowing. And it's the cost of borrowing that I really want to emphasize here because I want to think about how much, because most investors are borrowing to invest in property. And so this is the thing that I want to think about now, the uncertainty about this. So there's uncertainty here and driving the valuation of assets, but this is the thing that I want to focus on going forward here. So let's use an example for this purpose to connect the uncertainty about short-term real interest rates to uncertainty about property value. So let's imagine that you're buying a commercial property. Let's say that it's a gas station on the edge of Melbourne or the edge of Sydney, for instance. And it's offering a 7% return and you're expecting capital gain equal to inflation. So you're not expecting any real capital gain, but you're expecting the value of the gas station, the petrol station, to go up at 2.5% with inflation. And you're expecting a yield. Now, these yields have been really driven down because people have been driving up the price. Driving up the price or accepting a lower yield, same thing. Once we fix the cash flows in our mind, and we don't necessarily need to fix the cash flows in our mind, they're fixed in the lease contract. We've leased our gas station to British Petroleum, for instance, BP. And so we've got a long-term lease, we've got the cash flows fixed. So accepting a lower yield, paying a higher price, same thing. So let's say this is 7% return on the asset, the gas station. And here we borrowed 10 million. So it's obviously a big gas station, big petrol station, if we're going to be investing 15 million here. But in any case, we borrowed 10 million at 4%. And so we are funding our 7% asset, 2/3 of the funding. We are funding at 4%. Now this is a balance sheet. So the return on the asset and the return on the investments in the asset, the bank's investment and our investment as the owners, the return on the portfolio of claims on the asset and the asset itself, because this is a balance sheet, they have to be equal to each other. So 7% is equal to 2/3 times 4% plus 1/3 times what? That's the question. What's the expected return? If this is a return on the asset and we're financing it with low-cost debt, what's the expected return on the equity? Now, that's a simple piece of arithmetic. And what we get is the return on the asset plus the amount of leverage we have, the 10 over the 5, times the difference between these two. So we get a higher return on equity if we use more debt and if the difference between the return on the asset and the cost of financing the asset with debt is larger. And these two things come to 13%. So, I mean, it's easy to see that 2/3 times 4% plus 1/3 times 13% is equal to 7%. So it all adds up. Okay, let's move our example forward and think now about introducing inflation and real interest rates. So let's just say that the return on our asset is inflation plus 4.5%. And let's think about the cost of debt and the cost of equity in real terms, taking inflation out or drawing inflation out. So our cost of debt is inflation plus 2.5%. Now, where does the 2.5% come from? Well, it comes from the bank bill swap rate plus 200 basis points. So what we've got here, our bank bill swap rate is, this is the rate at which the bank will lend us money, is inflation. This is an interest rate. And this interest rate is inflation plus the real interest rate. You saw earlier, the cash rate is inflation plus the real interest rate. And the bank bill swap rate here is the benchmark we need. It's inflation plus the real interest rate. And this is the bank's spread on top. This is for the danger that they don't get their money back. And so this is about credit risk, principally. But this is about inflation and the real interest rate driving the interest rate. So we've got inflation plus 250 basis points. That's what you can see here, where the 250 is made up of real interest rate plus the bank's credit spread. Okay. And down here, we've got the real interest rate on our equity investment, inflation plus what? We use the same formula we used previously, return on the asset plus leverage times the difference between this and that. Now, these both have inflation in it, so the difference between them is not about inflation. The difference between them is the difference between this, the real part, on both sides, 4.5 minus 2.5. So this is going to be inflation plus 4.5 plus 2 times 2, so 8.5. Inflation plus 8.5%. That's what we're expecting here. Now, this is pretty risky investment. It's not even obvious you could borrow that much. You might only borrow 60%, in which case this would be more like this. You might only borrow 50%, in which case this would be more like 170 because the bank would have less risk. But in any case, just using our example of a lot of leverage here. And this might seem like it's not enough. That would be a statement that the price has been driven up too high for these petrol stations, these gas stations, and the yield that investors are accepting is too low. But the key thing here is that investors are expecting real interest rates to go way down. And they're expecting real interest rates to be, they're expecting that we're going to be in the pre-COVID world, not in the pre-GFC world. Because in the pre-GFC world, this might be 200 or 250 basis points. If that's 250 basis points, the pre-GFC world, then we put in 250 basis points. This goes up 2%. This is inflation plus 4.5%. This is 0. And investors are getting inflation plus 4.5, not inflation plus 8.5 on their expected long-term investment. So what I'm really just bringing out here is how critical the assumption about what long-term real interest rates will be for this asset, which is financed with a lot of borrowing. And the fact that people are driving these prices up for petrol stations and other commercial real estate like childcare centers and fast food outlets, etc., liquor stores, etc., is what's built into that is this belief about what happens to long-term interest rates. Now, if you're going to invest in commercial property, you've got to buy into this belief. I personally am good with that belief. I think that long-term interest rates are going back to the pre-COVID world. I think that we are going to go back to fighting deflation, but not everyone believes that. There's the Charles Goodharts and the Larry Summers of the world who believe that we're going back to the pre-GFC world of not fighting deflation, and that there's going to be a lot of competition for money, and that competition for money is going to be for investment, is going to mean that the time value of money, the amount you have to offer investors to borrow their money is going to be higher. They think that we're going back to a world where it's going to be better to be a lender than a borrower. A world in which there's low real interest rates, low cost of borrowing, is a world in which you want to be a borrower. A world in which there's high real interest rates, a high costs of borrowing, and larger benefits to being a lender is a world where you want to move more towards being a lender. Low real interest rates, a world of high leverage for investors. High real interest rates, a world of lower leverage for investors. Now, well, why do they believe that? Let's go back to understand why they believe that real interest rates are going up and why I don't agree with that. These are not really people to disagree with, but let me just sort of say why I, and the markets as well, investors in aggregate, don't believe that we are heading back to a world of high real interest rates. It'll help to go back and think a little bit about what happened in the nearly 40 years before 2020, when there were very powerful deflationary forces in the world. And remember that deflationary forces come about when the growth rate of supply exceeds the growth rate of demand for goods and services. In this world, where supply is growing faster than demand, then you've got deflationary forces. You've got falling inflation as supply grows faster than demand. And what was sending demand down or keeping the growth rate of demand down? Well, there was excessive saving. Instead of, baby boomers like me were saving rather than spending. So the demand requires that people spend, that they either spend on consumption or they spend on investment. And baby boomers, who demographically are like a pig moving through the python, baby boomers were in in this period were in the maximum part of their earning power, and they were saving a lot of money, which means lower demand. And it's also true that concentration of wealth during this period put wealth into the hands of people who are more likely to save than to spend. But there was very low investment during this period, or a deficit of investment. And it's also true that there was a lot of globalization, cheap goods coming out of developing countries, and the offshoring of jobs. When you move a job from Chicago that pays $40,000 to Mexico City where it pays $12,000, then you produce the same amount, approximately, but you just don't have as much demand. So all of these things were constricting demand. And supply was being grown by tech advances and by globalization, and especially the entry of huge numbers of new workers, new, often highly skilled workers, into the global economy. For those reasons, we had powerful deflationary forces. And the difference was made up here by extra government spending, extra debt, extra household spending from extra debt, but especially extra government spending. Now, we've broken out into something different here. And Larry Summers and Charles Goodhart point to this and say, this is not going back down. That period of powerful deflationary forces where expected inflation and real interest rates were going down, we're not going back to that. They believe that we're going to a world where we can expect, not so much that expected inflation will be very high, but the real interest rates will be high. And of course, it's real interest rates that have carried us up here. And they don't think that's going to be reversed. And they make these arguments. So Larry Summers makes these arguments that decarbonization is going to take $100 trillion and that at $5 trillion a year for 20 years to avoid utter disaster with global warming. And by the way, we're only spending $1 trillion at the moment. So $5 trillion a year. And that demand for money is going to drive up real interest rates. I mean, in the end, real interest rates are prices, or interest rates are prices. And it's demand and supply of money that determines those prices, those interest rates. And the demand for capital to both finance decarbonization and finance very large government debt, this is US debt going by 2053 to 200% of GDP, the capital needed to finance these things will only be secured if the cost of capital goes up, if investors are offered higher real interest rates. And then Charles Goodhart emphasizes this, the demographic changes of just having moved on in time, and baby boomers going from being savers to dissavers, to spending the money that they saved. And other people emphasize the slowing of globalization. The globalization had been a deflationary force, but it's now been slowed. Now look, I don't discount those things, and the markets don't discount these things. but they just put more emphasis on this. They believe that tech has accelerated and it's going to be utterly dominant. And that the powerful downward forces on costs brought about by AI and the reduction for the demand for workers, and also the plugging in of global workers into first world economies. People being able to work remotely from developing countries in service jobs in the first world, in developed countries, is going to have a powerful downward effect, downward force and a re-establishment of deflationary pressures. So, here, Summers and Goodhart are arguing that it's going to be the demand for capital. And over here, people believe that central banks will be forced to lower interest rates and forced to pump money into the economy, create new capital by buying bonds, and that will go from a world of high interest rates and the unwinding of quantitative easing to a world of low interest rates and more quantitative easing. And look, I'm in this camp. This doesn't necessarily come about straight away, but I think it comes about eventually. And I don't discount these things, but I think we go back to the conditions of pre-COVID and not the conditions of pre-GFC. And that's why I've been making the argument that investors should think about increasing their exposure to US shares. Yes, the valuation of the US share market is very high in terms of the CAPE ratio at the third highest level ever. And what's built into it is that earnings are going to go way up and the real interest rates are going to come down. Now, that might take some time to come about. So investors need to have a plan to get fully invested, but that doesn't need to be executed super quickly. Get into the market slowly to mitigate the timing risk of jumping into the market before it goes down and then later goes way up. So yes, I also believe that because high real interest rates are not coming back, because we are going eventually back to the world of pre-COVID, not pre-GFC, that borrowing to invest is going to work, and that investors who are borrowing to invest in property and driving property prices up, that they're not doing the wrong thing. But it's important to be on top of understanding this and watching what's happening. There's good reasons to really feel high uncertainty about these things, and you need to stay on top of it. That means that you need to come to the webinars we're going to run during the rest of the year. So reassess SAA and leverage, higher investments in US shares, higher allocation to US shares, closely monitor real interest rates for the level of debt. And think about taking my investments course, which is coming up on the 2nd of May, starting on the 2nd of May. Go to windlestone.com.au to enroll or to get more information. So I hope you enjoyed this webinar and that you'll come to the ones that we're going to have throughout 2024.